Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we are talking about financial statement reporting rules and required disclosures of income tax information. Not our usual tax topic for sure, but reporting income tax accounts and activity in a company's financial statements is a very important part of understanding a company's financial position and results. And the accounting regulators continue to increase the details and disclosures regarding taxes in the financial statements. Of course, what else would they be doing? So joining in today's conversation is Will Billups, partner and leader of our tax provision services team, and Lisa Macri, director with our tax provision service team. So Will, how's it going today?
It's going pretty well, Brooks. This is obviously an exciting time for us with a lot of legislative change on the horizon, both on the tax side for tax law changes and the codification for the implementation of 2023-09. I'm sitting in the Nashville office and looking forward to the discussion today. Thank you for having us.
Right. And Lisa, how are you doing?
I'm doing well. I'm happy to be here and be a part of this discussion. I'm sitting in from Atlanta, Georgia.
Right. Well, I'm sitting in Richmond, Virginia today, and it is particularly balmy, relatively speaking. I think we're 50 degrees and sunny, which is about 40 degrees warmer than it's been the last couple of weeks. And joining me, my partner in crime as always, Miss Sarah McGregor. How you doing, Sarah? How's life treating you?
Life is good. And here, I think this is the first 24-hour period where we've been above freezing the whole time. It's every week. So I hope that means that the worst part of winter is over. And we're rolling right into our super busy tax season period. So lots of exciting things. This time of year, I'm talking to folks about finishing their 23 returns, about their 24 returns, about planning for 25, and everybody wants to know what's going to happen in 26. That's way too many tax years. So we got to get this going.
Yes. It is a weird lining up of the constellations where we got so many tax years being talked about at one time. All right, so on to today's topic. Just a little background. The FASB sets the rules for information that is included in audited financial statements. For a number of years, the FASB has considered changes to its rules to require more information about income taxes and financial statements. Last year, ASU 2023-09 was introduced. It will require companies to break out more tax information into smaller pieces by jurisdiction. This is particularly important and onerous for companies with significant operations in multiple international locations. But that's not all the fun we're going to have. ASU 2023-09 is not the only tax reporting challenge companies will work through this year. All right, so Will, let's take it from the top. Let's hear the big picture on what is ASC 740 and why is it important for financial reporting?
Thank you, Brooks. ASC 740 is very important because it gives the financial statement user a snapshot of the tax position of the company. It not only breaks out the components of the company's current income tax position, but it also reflects taxes or benefits that will be realized in the future. That can be from the reversal of deferred tax assets and liabilities in future periods. A lot of financial statement users also focus on different elements that are driving the company's effective tax rate. ASC 740 provides detailed information about items impacting the total income tax expense in the income statement, as well as ultimately within the income tax payable.
So, Lisa, that's a lot to cover, and it's more than a tax return. What are some of the common challenges that companies face in thinking about AS 740 and how to apply it to their financial statements?
Yeah, so common challenges include implementing and adopting constant changes to tax legislation, especially in an ever-changing tax landscape. And then you couple that with meeting FASB reporting requirements. So some challenges revolve around the reporting requirements of complex entity structures, such as multinationals, multi-state, cross-border transactions, and in addition to accurately reflecting and reporting the impact of transactions in the financial statements. And then, we often see companies not leveraging appropriate technology that would assist in meeting their financial reporting requirements.
So finding the right tools and using them, given the compressed time frame to try to get all of this done. I can see that to be a tough challenge. So Will, about a year ago, I think Brooks mentioned it, we were talking with you and Brian Dill, our direct head of International Tax Services, about ASU 2023-09. What can you tell us about that, and why is it more important now that we are talking about this again?
Thank you, Sarah. We were talking about this, and it's really close. We're all walking into this. For 2025, public companies are required to adopt 2026 private entities. So now instead of being out on the horizon, it's here. ASU 2023-09 is a fundamental change to prior reporting requirements. 2023-09 creates a roadmap for income taxes, producing detailed financial statement disclosures. It's an expansion of more transparent reporting of income taxes presented in the financials. The pronouncement itself creates strict parameters for distinct buckets for the effective tax rate disclosures and outlays when and how additional details should be included for the required buckets. There are new requirements such as income taxes paid disclosures that need to be included. The most challenging aspect of 2023-09 revolves around the disaggregation of certain categories that are now required to be disclosed within the financials. This can be particularly challenging for multi-state and multinational entities that are taxed in multiple jurisdictions. The disclosure of income taxes across multiple jurisdictions becomes more transparent, and it's a lot more information that's required to get there now.
Yeah, well, anytime you use the word disaggregation, it just kind of feels uncomfortable, doesn't it? But anyway, we got 2023-09. It's brought changes also to the rate reconciliation schedule, requiring categories that meet a certain threshold to be further disaggregated. Like, I love it, more disaggregation. So, Lisa, how have you and your team worked with companies on the rate front?
Yeah, so first and foremost, we've communicated these changes with our clients that are public companies and that are required to adopt ASU 2023-09 and 2025, especially with them, communicating the understanding of what categories are required to be disaggregated and what that can mean for them in this kind of upgraded reporting process. We've also kind of assessed with our clients those that might want to early adopt this pronouncement. And then we've begun measures for implementing the new reporting process, such as leveraging technology that will assist us with this disaggregation of new categories.
Yikes. Yeah. So I'll just say for a lot of private companies, this could sound scary. So, Will, what should CFOs and tax directors of multinational companies be thinking about now? What should their first step of action be?
Thank you, Brooks. This is the time everybody needs to be paying attention. A CFO should be ensuring that folks in their organization understand the additional information that's going to be needed for the enhanced reporting requirements. And a CFO should determine the best way to go about gathering this information internally. CFOs should be familiar with the categories that require disaggregation and whether their company meets the enhanced reporting based on the thresholds within 2023-09. This is all top of mind and something that everybody ought to be aware that this is a lot of additional information we've got to go data mine to get to the answer that we're going to have for disclosure requirements.
So enough about all this disaggregation stuff. That sounds hard. Let's talk about some good news for companies that happened this year. That is the transferability of energy credits. I think I've heard from a lot of C corporations wanting to acquire these credits to pay their taxes essentially at a discount. So, Lisa, what are you seeing and how does this fit into financial reporting of taxes?
Well, we've certainly seen a lot of companies take advantage of this new legislation, like not only in 2024, but in 2025 from both the buying of transferable energy credits as well as the sell side of these credits. And so we've really been leveraging the guidance within ASC 740 of how to account for both of the buy side and sell side of these credits. And really, the key is to understand the nature of the credit and the nature of the transaction, and how energy credit transactions will impact each component of the income tax disclosure, not only from a current income tax perspective, but deferred balances and deferred taxes as well.
Okay, let's pivot to another area, acquisitions and or dispositions. So Lisa, what nuances or what are the things that CFOs should be looking at in that area as it relates to our financial reporting?
So when it comes to transactions, you should definitely understand that there's different ways to structure a transaction to achieve an overall result. And these different kind of structures may have different tax consequences and other consequences from an income tax and financial reporting perspective. For example, the way a transaction is structured could have unique requirements when it comes to purchase accounting, the reporting of deferred tax assets and liabilities. It's also important to understand the advantages and disadvantages of different deal structures and the way transactions need to be reported.
Wow. Okay. So now we're going to talk about something that I do find exciting, which is pass-through entities and pass-through entity tax rules. And I just say that as a partner in a partnership, they bring great tax benefits. So but they also bring tremendous complexity, and every state does it differently, very differently. But as a general rule, pass-through entities do not have income tax provisions. And pass-through entities, we're talking about partnerships or maybe S corporations. So how does the prevalence of pass-through entity tax elections impact financial reporting, Will?
The new pass-through entity tax regime has really changed the landscape. There's been a lot of thought leadership that's been published. The AICPA published some examples and guidelines to follow related to this. Ultimately, the treatment will come down to determining when the entity bears the burden of the liability. Whether that falls upon the pass-through entity itself or another party will determine whether or not an entity actually has an income tax that it needs to be presented in the financial statements. These PTE elections need to be analyzed, and income taxes may need to be addressed for financial reporting purposes. It's a jurisdiction by jurisdiction analysis that needs to be completed for the jurisdictions and entities operating, because you've got to go to whether it is the entity or the owner or both that are ultimately liable for that tax liability.
And I guess just to clarify in my own mind what you're saying, that PTE tax in one state may be a tax expense on the financial statements, but a PTE tax in another state may just be a distribution on the financial statements. Do I have that more or less correct?
That's exactly right, Brooks. So when you're doing the analysis of the jurisdiction by jurisdiction liability, if it is a true entity level liability and there is no actual liability of the owners, then it becomes an entity level tax. In that situation, that entity would have to reflect the income tax expense and impact of that PTE election on the entity itself. Whereas if it was ultimately an owner level tax, then the owner would treat that as a distribution.
Cool. So Lisa, we can't avoid not talking about the potential for tax law changes that are planned to occur here in 2025, maybe taking effect in 25, maybe taking effect in 2026. So what can you tell us about that, and particularly how do companies think about this with taxes in their financial statements?
Yeah, so the important thing to remember is that tax law changes impact several aspects of income tax reporting, not just from an increase or a decrease in a tax rate, but we've also seen how tax legislation can cause a non-tax paying business become tax paying. I mean, we've seen this with Section 174, for example. as well as the net operating loss provisions from the TCJA. And another important thing to think about is these legislative changes could have an impact on a company's need for the assessment of a valuation allowance or the release of a valuation allowance. So it goes a lot further in assessing, reporting requirements beyond just the simple change in tax rate.
All right, Will, I'm going to ask you kind of a kind of a simplistic money question here. If we have a rate decrease, a C Corp tax rate decrease, which President Trump has said he wants, and it's effective in 2025, can that have an impact on 2024 financial statements as far as your provisions?
So this would be considered a subsequent event for 2025. If legislation were to be passed in early 2025 that was known prior to the actual issuance of the financial statements, a disclosure for a subsequent event may be appropriate. It's something that a company will have to evaluate on how to address this. All legislative changes will be, the date of enactment is when you will be reflecting this. So it's most likely going to be presented with the true impact in the 2025 financials. And this is obviously for calendar years, not fiscal years.
Right.
But a subsequent event may need to be disclosed related to this.
Got it. Thank you.
Last time with TCJA, it happened so close to the end of the year and became effective the first day of the next tax year. We didn't have that, but we certainly had to deal with the change in tax rates affecting financial statements beginning January 1 of 18. So
one item to note on this too, Brooks and Sarah, is that it's important to be planning ahead. If we know that we are deferred tax asset heavy and we're going to have a tax rate lowering event, then we should be trying to accelerate those deferred tax assets into periods now. This is why it's so important and why we're talking to clients now about utilizing deferred tax assets to get a bigger bang for your buck at a 21% rate than you would get at a 15% rate if a tax law change comes into play for the rates. So it's very important. If you have questions or concerns, reach out to our team. We're happy to help.
Yeah. And CFOs can get excited about a 6% effective rate change, whatever, for sure. All right. Let's move on to some final comments on today's session. So we'll start with you, Lisa. What words of wisdom would you like to leave with?
I'm a big contender of planning ahead and, learning as much as you can about what's to come and what's out there and how that can impact you.
Thank you. And Will?
There's a lot of uncertainty on the horizon right now. We do have certainty with some of these changes that have taken place. So I think it's really important for companies to get on board and understand what these current changes will impact their financial statements and their tax position, just to be prepared for what uncertainty may lay in the future.
And Sarah?
Well, as always, the financial statements carry information to users that is very valuable. And as the FASB has seen, and as we see, taxes play a greater and greater role in those financial statements. So I'm not surprised that they're asking for more detail, more information, but that asking for more doesn't always make it through to companies to provide the resources, the time, the support to make sure that these complex disclosures are handled well in their financial reporting.
For myself, I'm struck at the breadth of the potential changes. I know that, we really harped on a year ago the depth of the changes when you're in the international space, but this is really showing breadth. If you're multi-state, you're multinational, and it's not that hard to become one of those two. And, there are certainly businesses are truly solo jurisdictional, but it doesn't take too much to get your supply chain or your customers outside of your home state these days, the way all the tax laws are working there. And with all the upcoming change in the tax law, I know we don't know what all those changes are going to be, but I'm willing to bet we are going to have some changes. So it just seems like the time is right for these type of conversations for sure. Okay, that's a wrap on this discussion of reporting income taxes and financial statements. Thank you for listening in. A quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Will. Thank you, Lisa. And thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.